So that's hopefully a few items there on income and expenses. The next series of slides really looks at super. So if I can just reiterate that disclaimer, because superannuation is a very, very specific and legal area, and you know, to be giving financial advice on super, you certainly need to have the appropriate licenses. So this is not professional advice. I'm not giving you individual advice, please, listeners. I'm going to give you some information that hopefully gives you questions to ask when you go and see a professional advisor, because what we find is the power is in the questions that you ask, and you can normally get a lot better advice if you're armed with the right questions and you ask enough of those questions. So superannuation is a very significant topic that is in the press, I think, nearly every day. And one of the reasons is because of the very concessional tax rates that it has versus what people would pay outside of super. So capital gains in a superannuation fund is the gains are taxed at 10%, and income is taxed at 15%. Notwithstanding, of course, the latest out of the federal budget, where certain income earners may have to pay up to 30%. But even at 30%, if that's lower than your marginal tax rate, then for a lot of people, superannuation is a very good vehicle for wealth creation. And that's really the way I'm going to talk about the next two slides. Superannuation should be seen as one of, can I call it, the buckets of wealth that you have that you will use during your lifetime. So when you're buying properties outside of super, you can obviously tap into them as their equity grows. The one in super, you can't. But the big advantage is the concessional tax rates up until retirement, and the nice big round zero tax at once you get over 60. So when you're looking at capital gains in your super, if you've sold a property, or it obviously applies to any asset, it's taxed at 10%, but make sure that you deduct all available. And we often find, particularly in super, people don't do the same due diligence on maintaining expenses. So borrowing expenses, obviously, you can write off over a period of time. Your legal fees, break fees is a common one that a lot of people forget. So if you had a bank loan and you sell and the bank charges you, you can reduce the profit. If you're on a fixed interest rate and you sell the property and you have to pay a break fee, again, that's a cost that gets added to the property to reduce your profits. One of the ones we see a lot of people missing out on, and it's missed out also when people sell property outside of super, is the depreciation associated with the building, the capital works. You need to add back that amount that you have written off through the capital works, the building depreciation. So that will increase your profits by that amount, and then the tax accordingly. So that's certainly a trap for many, many people. The other thing is, when you're looking at a property to sell, obviously your real estate agent's fees, advertising, all those expenses obviously go towards reducing that capital gain. And at the end of the day, you calculate your profit, 10% tax, and then you